So we've been watching this for some time, for years, and we've been analyzing why. And as we look back, we see how this kind of evolved from 2012 to 15 to today. In 2015, without getting into too many details, the markets really did collapse. That's the Shemitah year, by the way, for those that were paying attention. And they actually were collapsing. Now, understanding the way this fiat fake currency system works, the United States dollar is weighed on a scale to our European allies, Japanese allies, and they do this as a scale. As one goes up, one goes down. So it's not really accurate on its real value, of course, because it doesn't tie you to your actual asset or liability matrix. But there was a tremendous problem in Japan in 2015. And so there was this phenomenal trade of slamming on paper, shorting down the gold market. At the same time, money, printed fake money, leverage money was going into the Japanese Nikkei stock market. So it's fascinating when you see the correlations, and it was all designed to move things in a certain pattern. And the dollar was low, and it allowed the dollar to rise as we've been seeing today. And so the whole thing was manipulated. But 2015, we should have naturally cleansed our cycles, and we did not. We're 3 years now, going on 4 years, way beyond the natural cycle of things. That's not good, because we've expanded now, how many more trillions in those 4 years? Printed currencies. We have tremendous inflation on our goods and services, but here's the biggest question. How many of us are really better off? And if we are, by how much? And if everything's going so well, but we're seeing layoffs, we're seeing cycles peaking and topping, we're seeing banks on the verge of collapsing in Europe, here's the biggest problem. If our lives are in this state that it's in now, some are good, some are still middle of the road, some are not, many are not. I have a lot of close people I know that are not nearly as well off as we should be. And the questions are why? But here's the bigger one. If we're at this level now, what's going to happen when these markets come off? We're just now coming out of the swamp, which maybe is a dirty word now, right? Although I hope the whole swamp gets drained politically. But we're coming out of the economic swamp. We're just drying off. And here we go. Are you prepared? And if you're not, I highly recommend being serious about being diversified. And I've been saying this for a little while, and it's okay, because at least you can sleep at night if you own the physical. Because that 50–60% market drop, if it goes that hard, which I believe it will be a sustained one for years. And can you sustain that? Diversification allows you to at least have a portion, a third of it in a physical tangible. So if the markets collapse, this adds value, you can equalize to some extent. You want to keep that in mind. So we're talking about the central balance sheets, or the central banks. This is the real issue here. And this is why I think we've entered into this chaos, is because they just arbitrarily have been printing up fake currencies and then turning around and buying stocks and ETFs in the stock market, especially in Japan. It's insane. They're printing money out of thin air and then buying the stocks in the market. And you think that's exciting? It's dangerous is the problem. We don't know where that shoe drops. And Deutsche Bank and Germany and Italy are a big shoe to drop. Look at this central bank balance sheet expansion. This goes all the way back to 2002, so it gets you kind of a picture of what we went through. The first major crash recession we had in 2000, now that we could weather. If you notice there, we were low. It was nothing really. And then you come up to 2008. Since 2008, do you notice where we're at? To where we're at today? Yeah, they call it peak quantitative easing. That was 15 trillion since then of expansion. That's a big number, you see. And all that time, most of us did not reap much benefit. We didn't really reap it until just maybe recently. And so there's been this big flood of we the people going back into the marketplace financial advisors kind of, hey, what are you doing? You're missing out on the best opportunity. And yet this year alone, the market will be down, is down from the high, and yet inflation has crept up. Regardless of the official inflation numbers, don't listen to those. And then you have now faced with all these cycle tops. I mean, where does it go from there, right? So we know that there's an issue in the money supply. We know the money printing has happened. We know the cycles are peaking. But what's the consequence to we the people, right? Look, there's one consequence. The median asking rent for vacant or rent units, going all the way back to 1995. But I just want you to go to the middle to right in the big shaded area there, 2008, where the average was about $700. And now today it's upwards to $1,000, right? What is that, a 40% increase? This is rent. Not counting food, not counting clothing, not counting gasoline. That's a 40+% inflation on just rent. So if you've been investing in the stock market and you haven't even made 40, 50% on the money since 2008, you're actually negative because the buying power is not there. So during this Christmas time, checkmate your materialism to some extent. Don't rush out at the last minute to get those big gifts. Really, make it about the spirit. Make it about love, because you're going to want to save. You're going to want to be prepared. And I highly recommend getting, at least starting the process if you have not. Being diversified. A third at least won't hurt you until you get double, triple confirmation in your spirit. So until next week, my God bless you this leading up to Christmas, and we'll catch up with you. Actually, we'll be here Christmas Eve night. So God bless you.